Hello and welcome to Profiles in Risk. This is your host, Tony Cañas, recording today with Matthew Queen, the Chief Risk Officer at Goldner Capital Management and an expert in captive insurance. Matthew, how's it going today?
I'm doing very well. Thank you for asking.
Awesome. Thank you so much for joining me today. It is 4:08 p.m. Eastern Time, Friday, October 14, and we are both in Atlanta. So for me, this is my last chat of my last meeting of the day. So it's been a long week, a good week, but a long week. So I'm excited to be at the last one. And with both of us being in Atlanta, I apologize. We should have planned to record in person. Didn't even think about it. Maybe next time. Matthew and I actually met on the plane, since we both live in Atlanta, on the first flight of the day, Monday of ITC, on the way to Vegas. And I can't, I had to ask you how we met. So remind me, like how did I say, hey, are you going to ITC, or how did we actually connect?
I was one row ahead of you, or two rows ahead of you in Comfort Plus.
Mm-hmm.
I had the seats like right as soon as you get in on the right through the door. And when you walked by, I was like, gosh, that guy, I think I've known him. And then you pulled out the top hat. I was like, oh, I know who that guy is. I know who this is. And then when we landed, I talked to you for probably about 15 minutes right there in the airport. You were stoked about ITC. I mean, I'd never been to what I call an InsureCon. That thing was huge.
Oh,
I've been to.
Okay, wow.
It was my first time. So we went. So I've been to a handful of insurance conferences in captive land: North Carolina, Tennessee, departments of insurance, DC, and those all have several hundred people. Then the big swingers are going to be Cayman Islands and Vermont. And I haven't been to Bermuda, but those are similar size. Those have multiple thousand. ITC was what, 12,000 people?
Yeah, so? I think something like 10. And
wild, so huge. And then you look at just like who's there in the hotel. So people. I didn't know this about Las Vegas. So the main event was in the Mandalay Bay, which is kind of like the upper scale of three different casinos that are all connected. You got Mandalay Bay connecting to the big pyramid called Luxor, connecting to the cheesy the Excalibur. And almost all three of them were exclusively insurance nerds. And it was wild because I got one of the last, so I couldn't get into Mandalay Bay. Price was no object. The company was paying for it. I just couldn't find one. So I rented a hotel room in the pyramid, and my buddy who was coming with me, he registered 5 or 10 minutes after me. Couldn't get into Luxor. He was down in the Excalibur in the smelly, highly outdated rooms. And I feel bad for people who go to the Excalibur because it's a nice, affordable place, but they just haven't kept up with it.
So funny story. So last year, I stayed at Mandalay Bay because I was still at Jacobson. And so I had the expense account. Now I'm independent. I don't have the expense account anymore, but now everything's tax deductible.
Nice.
So broker Brett clued me in and said, hey, it actually makes a lot of sense to stay in Excalibur. They're connected by a bridge. And there's actually a really nice Irish bar in the middle of the bridge, a great place to have like the last meeting of the day before you go to bed. Excalibur right now is super cheap. This was before Mandalay got full. So I went ahead and I booked, and I had just started my new practice. So I had no idea how well it was going to go. It's actually going really well, but I was being really careful with expenses. So I booked a room for $45 a night at the Luxor. And I made sure to grab 2 queen beds, not a king. And basically, I started telling a bunch of people, hey, I have an extra bed. If anybody wants to split the room, your half is $22.50 a night. But I did not book, I didn't book a hotel for Thursday because I know that I won't make it back to the hotel on Thursday. So basically, like I'm happy to room with anybody for $22.50 a night, but on Thursday, we're homeless. So Zach Tempesta of a light ship neuroscience. I had met him at InsurTech Hartford, and he's a fellow long-haired hippie like me. In his case, he's a San Diego surfer. He's like, I'll take you up on it. So yeah, we roomed together, had a great time. So two things were super funny about it. Number one, he's from San Diego, and I live in Atlanta. So I run in Eastern time, he runs in Pacific time, right? So the first night, I'm like, okay, dude, I'm going to bed because I'm right. It's late Eastern time. But nothing bothers me. So make noise, keep the light on. I don't care, and I'll be up at like 4 a.m. right, because I run in Eastern time, and normally I wake up at 5 Eastern. So I'll be up at like 4 a.m. I'll shower and get out of your hair. So if it hadn't been for sharing the room, I would have probably stayed in the room for a little while before going downstairs. Well, I end up going downstairs, grabbing a coffee at the Starbucks, and sitting at the coffee at the table right by where people pick up their coffee. In an hour and a half, I did not schedule a single meeting for ITC. I never do because I know that I won't show up. I'm too ADHD, and the place is too large. I'll lose track of time. I just won't show up, especially as I sleep less and less each night, right? So I'm there just walking around meeting people. So anyway, long story short, I sit at the table right by where people pick up their coffee, and I'm just gonna catch up on emails. I had 10 meetings. Ended up getting 3 searches out of that hour and a half. So basically, like I could have not registered for ITC, showed up, spent one night at the Luxor for $45, and made enough money from that morning to pay for the rest of ITC. Like that's how productive it was for me. And one last. So then, as soon as I got back home, I found out that the new dates for ITC for this year is Halloween week. I am a Halloween nerd, right? Like you saw my costume when it's not Halloween. Like it's gonna be crazy. So
Right.
I looked at the Luxor again, and the rooms were like $80. I went ahead and booked the room 396 days before the conference, and I messaged Zach, and I'm like, hey, I got a room for next year.
That's great. I I had a similar, I mean, I was making a joke earlier about price is no expense because I was paying $75 a night, but man, I got robbed. Yeah, you got a tremendous deal. I also met broker Brett IRL for the first time. We met up, so I went with my friend to lunch at that exact bar you're talking about, the I think it was Reraw between
It just
Mandalay
makes
Bay
so
and
much
Luxor.
sense.
Yeah, and like we just sit down, like 'cause we just had like a successful morning, and I was in the same boat as you, not a single meeting. And my buddy's an insurance defense attorney, so he's looking to get on somebody's panel. It's kind of a stretch for him to be there, but I just so happened to meet one of the senior dudes at a very large TPA going up the escalator as I was going down. And he was like, Matthew, and I was like, Jeff, and then we immediately like hang out, and I was like, oh, by the way, this is my friend. And my friend, they were like, oh, do you do workers comp? And he was like, I'm a workers comp specialist. And it was perfect networking. Like I couldn't have planned it any better. He had a big laugh. So then we went to go celebrate a little bit of good fortune, and Reraw has my absolute favorite beer, Victory Golden Monkey. And that's where broker Brett just like looks over at us having a nice time, and then he just sat down and joined us, and he told me about what's going on in InsurTech and some of the things he's into, and it was just fantastic. It's good to have those things. I guess post COVID, I'm still in kind of a warm glow about not being remote because I work remote. I assume you do too. So getting out and meeting people with similar likes and interests is A, extremely educational. And B, it just kind of feels nice because my wife does not want to talk about insurance like ever.
My girlfriend is a fellow CPCU. She's also in insurance, and she doesn't want to talk about insurance either.
Okay.
I'm not only a remote. I've been remote for 2 years before COVID. My girlfriend's been remote like 4 years before COVID. I'm basically a digital nomad now, and actually, this is the first time that I say it on the podcast. But our plan next April, when the lease expires here in Midtown Atlanta, we don't have kids. We don't have anything holding us to Atlanta. I mean, Atlanta will always be kind of home base in the U.S., but we are taking off and spending a year in South America. We're getting an
We're
apartment.
doing something similar. I mean, there's nothing wrong with that. So we do have a kid. But my wife's father has built a house in Poland. So what we're trying to do right now is we're starting to get our ducks in a row.
Where at?
Next July, we would like to spend several weeks in Poland. I'll be working. You know, that's just a 6-hour difference. It's a little bit ahead of Eastern time. But you know, we'll just fly over there. The kid will hang out. My wife speaks Polish. I mean, she's from Poland. And I'll basically, like, every night, you know, I'll just go out and hang out. And every morning, or I guess, you know, I'll just be working 8 hours a day.
Our long-term plan is Portugal. But
Ooh, that's a nice one.
Oh my God, it's amazing. We've been all over the world, and Portugal is probably my favorite. But for now, I'm still afraid of the time zone because I'm a morning person. So like if I wake up at 6 a.m., like normally I wake up at 5, but let's say that I wake up at 6 in Portugal, it's like midnight Eastern time, right?
Yeah.
So that's why we decided first on South America, because it's Central Time, basically. Okay. So captives. What is Golder Capital Management?
So I run the captive insurance company for Goldner Capital Management. So I'm the CEO of a little captive, and I effectively reduced their general professional liability spend by 25 or 30% just by putting everything into a captive. And in our world, that is a material amount of saving. And it's material anywhere, but
anywhere, absolutely.
But GLPL for old folks' homes is an absolute nightmare. So it's routine. I mean, an average premium for a 100-bed facility will range anywhere from $150,000 to $250,000 annually, and you're not going to be profitable if you own one. So if you're an owner, you need to have 10, 20 of these things before you can really have enough cash flow stability to be profitable. So what's that sound like? It sounds like about $2.5 million to me if you're an average SNF owner. So these guys, I come in there, I reduce the GLPL significantly by wholesale pricing all of the risks. And then what I did was I directly negotiated with reinsurance to sit there and set up, well, really a front. We capitalized the captive, effectively just, you know, self-collateralized through the payment of premiums. And it was a tremendous deal. They saw immediate cash flow improvements. And then I am an attorney by background, so I manage all the claims. And we've been extremely aggressive on claims. I picked the panel myself. I've radically reduced the allocated loss adjustment expense. And I did that by, I mean, I've run a claims department before. And so I know exactly what the reporting process looks like. And I've also been a defense attorney, so I kind of sort of know where they milk you. And I just talked to every one of these partners and I said, look, I'm gonna, like, here's my deal with you. I will pay you the market rate, whatever you think you're worth, just give me the number. And in exchange, I want you to cut the bullshit. And they did. They loved that. They would rather just do the litigation, and you cut out most of the reports, and you have interim reports coming to you on a material change in the case, and followed up by a phone call. So that reduction of paperwork on the back end helps. And then I've also set up a team on the front end so that when we do have a notice of claim or a notice of intent, we get all the medical records put together. We do a whole bunch of reporting. We do a lot of front end work so that the attorneys are just doing law as opposed to having to chase down administrators, chase down directors of nursing.
They love you.
15, 20 hours doing a whole bunch of, quite frankly, very administrative work at the partner level. So those two strategies together have effectively reduced industry average ALA is going to range from 12 to 15%. Our captive is going to come in there somewhere. I mean, it's hard to say because the first year is too good to be true. I mean, I'm looking at anywhere between 7 and 9%
So,
ALA.
Eventually, there will be a bad loss year, right? Like
yeah, guaranteed. I mean, it's not even eventual. Like, it's guaranteed. We have a frequency of severity problem in skilled nursing. So that's why I say 4 out of 5 years we can be profitable, but one's going to knock you. So you need to maintain some degree of surplus, and there's a whole bunch around that. So I think what's interesting about captives is that this strategy can be pivoted into any industry. And everyone's talking about property insurance right now, which historically was not a good place for captives.
Mm-hmm.
But property's gone really, really crazy subsequent to Hurricane Ian. And the numbers are still manifesting, but it could be a $75 billion loss if you include the NFIP and all the extra and citizens reinsurance and the reinsurance right now, reinsurance markets, whether you're looking for quota share treaties or FAC, they are extremely hard. And really where I see this going is the available capacity will stay very expensive for at probably a year. But I think another way of saying it is just the foreseeable future. Property is upstream from everything. So, and another way of saying is casualty is downstream from property. So we are going to see in casualty land a hard market that is, it's probably going to get harder next year. And I would not expect any relief. Now, for an area like me, where we've already been hard, times are about to get even worse. So I think there's some opportunities here in property that have not been explored before that are going to be necessary, in particular with Florida coastal, whether it be commercial or residential. I think people need to start thinking of alternative structures and start thinking like a program. So what a program is effectively, you're not just slinging an insurance policy for some carrier. You're going and putting together like a new way of deploying capital into the market. So you're going to have an underwriting philosophy. You're going to have the claims management philosophy. You're effectively doing a startup. But I think that the time is right. It's never been right for property until now. And because the residential costs for a home could very well be 25 to 30 grand a year, the cap rate on these REITs are just going to go down for all that residential investing they've been doing. And then don't even get me started on commercial, whether it be multifam or commercial office. The cap rates there are going to get destroyed too, because those property insurance policies are likewise going to get hit hard. So here's a solution. Use a group captive to have a bunch of people pay premium into some sort of working layer of risk. So if you had $1 million home, let's just say you would self-insure the first $100,000, which doesn't sound very pretty if you own a $500,000 home. Unfortunately, I don't have a good solution for that. But if you're talking larger homes, like $1 million and up, this may work. Then what you would do is you would have a shared risk layer that you put somewhere. Traditionally speaking, this is called the AD captive solution. So what you would have is like effectively a deductible that you finance with your captive. So instead of paying, $1,000 deductible, you pay premium toward that $1,000 deductible and take a tax deduction along the way. So likewise with property, what I would say is you take a deductible, you finance it with the captive, and that deductible will go to your first attachment point. Let's assume it's $100,000. Then between 100,000 and 500,000, you will have some sort of a working layer, either with reinsurers, either the group everyone will start contributing to it, or we may have some other solution in place. And that's the B structure. So then above $500,000, you'd have traditional insurance, excess of loss, attaching at 500,000. But there's more ways of doing it. A parametric insurance policy could very well replace any place along that line. So let's say, for example, you will enter into a contract that says if wind speed exceeds 75 miles per hour, you get a guaranteed payout of your home of X. Maybe it's $75,000. Now, you will be on the hook for that balance of that $25,000, but that's a hell of a lot better than having to sit there and pay a tremendous amount of insurance, because the parametric insurance policy should be 35 to maybe 50% cheaper than what you'd see in commercial. So what you do is you have the parametric take up a good chunk of the risk, take a large deductible, finance that large deductible with the captive. Now, maybe it's not 100,000, maybe it's 50 grand, maybe it's 45 grand, it doesn't matter. The point is it'll be market dependent. And then you use reinsurance above and beyond the parametric policy. And what this does is it allows you to get radically cheaper insurance by abrogating indemnification. So if you can say for sure what the expected payout is going to be based off of the wind speed, then you can price that better and you can get a much, much lower premium. The premium is expensive because they have no idea if it's going to be a category 3 or a category 7 hurricane. So another thing to keep in mind is that captives have 4 functions in it. You have to have an insurable interest, which is basically anything that you would normally sell. You have to have insurance in a commonly accepted sense. So you got to run the sucker like an insurance company. And that's what the captive manager does. That's basically my job. Then you have to have risk shifting and risk distribution. So risk shifting says that your captive needs to be collateralized with enough money to be real. Well, we can solve those problems on the insurance industry side with either surplus notes, or we can work with the regulator to get to a large enough premium to surplus ratio, like maybe like a 5-to-1 or a 7-to-1 ratio, so that the initial footings of the company will be enough to bring in people without having to have huge liquidity events. Then the last thing you have is risk distribution. Risk distribution is kind of the challenge here. And this is where the AB fund really is going to shine. You could have, earlier, like I said, the deductible will be from 0 to X. And there's a shared reinsurance scenario from X to Y. Generally speaking, that's to maintain enough risks within the captive so you have real insurance. So think of it this way. Can you make a captive to insure your cell phone? No, because you have one cell phone. But could Apple insure all of its cell phones through a captive? Obviously, yes. That would be crazy to suggest otherwise.
So somebody was asking in one of the insurance communities that I participate in online. Somebody was asking about that very question. How does Apple insure Apple Care? Like, who carries that risk? And somebody goes like, oh, they're like the program is put together by Aon. That's all I know. And the rest of us were like, it's likely self-insured. Like, Apple has more than enough money to do that. They just have right. So it's likely it's likely a captive situation.
If I had to guess what the Apple Care looks like, is it's probably a warranty policy that they put together in some sort of a captive insurance company, and then they pay premium to finance the payment of those warranties, and they take a tax deduction for doing so. Because under Internal Revenue Code section 162, insurance premiums are tax deductible. Just as you deducted your hotel expense, you in turn are also deducting any business insurance expenses you have. Likewise, the only real difference, and I'll break down to you. Everyone acts like captives are special. You got two bank accounts. One's got $100, the other's got $100. All I'm doing is turn the second bank account into tax deduction. I mean, there's some boxes you have to check along the way, but financing the risk is financing the risk. So the big thing for a company, or even in individual participating in a captive, is all that money you would spend on the deductible or however much the risk you take can be deducted if you put it into the captive. And what happens if there's no claims? You get all that money back. So you just took a big fat tax deduction on the front end, and then you get a distribution on the back end. That's the definition of making money. So you're lowering your tax bill on the front end, and you're potentially getting some of that money back. Now, when you do a dividend back to yourself, obviously you have to pay personal income tax. There's no free lunch. But that's a shitload better than just paying a whole bunch of money and getting nothing back. And that's one of the compelling interests where Apple's going to be winning. So how often do you use a warranty? This is one of like the great scams in insurance, warranty. So nobody uses a warranty. Warranties have like a bond level loss ratio. We're talking like 1 or 2%.
Hold on, I do have to pause you there. Okay. Oof, we have to be very careful when we talk about scams in insurance, because the overall population believes that all of insurance is a scam, right? And the great majority of insurance is not. Now, there is such a thing as bad insurance, and make friend with an actuary, and they will happily tell you.
You want to go back and redo that, because I can absolutely just pick
no worries. There is such a thing as bad insurance, right? So like cancer insurance is an example where ask any actuary, they'll tell you, no, that's sold out of fear, and the chances that you'll actually use it are tiny, and actuarially speaking, like you're throwing money away. And I'm not an actuary, right? A warranty for the most part is the same, right? Warranty is generally not a great product for the consumer. I myself.
Let me tell you where we're coming from with warranties and captives. In the producer-owned reinsurance corporation, it's called a PORC. These things are routinely used by auto dealers. And for the better part of about 10 years, this was leading the captive industry, at least in terms of the frequency of captives. And what it was the F&I department, the financial and incentives department, I don't know, or the finance and insurance department for a car dealership, they were selling warranties all day long. And they eventually got wise and said, look, these commissions we're making on insurance are nice, but I'd like to make more. So then what they did is they created a captive called a producer-owned reinsurance company. It is a reinsurer to one of these warranty policies. And the warranty guys, they went along with the deal because, you know, car dealerships are bigger than people think. They have real leverage. So if you're producing, let's just say 50% of some guy's book, and you say, look, I want to reinsure this and take some of the underwriting profit, that underwriter is going to say, okay, because you hold a lot more leverage than you think. So that's how they got into the game. And you have to further remember, car dealerships, it's not just like Joe Blow has some car dealership. I mean, you think of like in Atlanta, you got like Jim Ellis Honda, like he's all over the place. He's got multiple car dealerships. So he's a significant chunk of profit to somebody. So when someone like that comes up with a captive, the warranty dealer will make a deal and they're profitable. So if you can sit there and just effectively drive, you know, $700,000-800,000 of, you know, tax-free money into your captive, and then use that captive to start investing in real estate or other extraordinary investments, all of a sudden you create a nice little machine for yourself. And that was the state of captives for a long time. That was in a soft market where more sophisticated solutions like in casualty or property just weren't really cost efficient. Times have changed, especially since COVID, where now we're seeing like more meaty captives that kind of look more like my program, where real claims are getting paid. It's very much a legitimate insurance company, and they can be used to magnify programs. So let's assume, for the sake of argument, one of your listeners has an idea. We have a new mousetrap. We're going to approach workers' comp a little bit differently. Well, workers' comp is a little regulated. D&O, we're going to go after directors and officers in insurance a little bit differently. We have this wonderful way of underwriting the risk. Well, you need to go get some paper for this, like a front. So you go get your AM Best rated paper. They say, thank you, we love your idea. Go get some insurance, reinsurance, and we'll consider it. Then you go to the reinsurance markets and they say, I don't know, you're asking for us to jump into D&O. That's a frequency of severity issue. Meanwhile, you sit there and say, no problem, bro. I'm going to take the first 10% of every risk in my captive, which I've collateralized with a surplus note. And oh, by the way, all I'm asking you to do is ride or die above that. So I'll take the frequency, we'll take the working layer, and then all you're doing is going excess of loss above something else. That makes you more marketable. That brings the reinsurers to you in a situation where otherwise you're pitching. Now you're kind of telling them like, hey, why don't you join me in something where I'm doing some work with you? I think that's just one way of doing it. You can go to reinsurers and use your captive to sit there and make facultative treaties, because captives can directly negotiate with reinsurers. So what a quota share is easier if you can live with a little bit more admin. Like if you, for every single thing that you underwrite, if you can have a reinsurer offering you fact treaty on each risk, then what you do is you just have to save that certificate to make sure that you're within the underwriting box, and you're effectively getting to a quota share by another way. And that's another strategy that you can use to sit there and make yourself more marketable and get your program to the market.
Holy crap. So I have learned more about captives today than in 12 and a half years within in insurance. I have my CPCU. I don't have my ACI, but I do have my CPCU, my ARM, and a bunch of other designations, my ARE. This is so interesting. And by the way, I've got to take a quick parenthesis to say, I absolutely love the fact that for the first 32 minutes of this conversation, you did not talk about tax savings. And the reason I bring that up is because so often captives get brought up as a way to save on taxes. And, you know, if they save you taxes, fantastic, but that's not what I care about, right? What I care about is captives as a way to manage risk and as a way to insure risk, right?
Yeah.
And that's exactly what you're talking about. And you have just a gift in bringing this esoteric world of captives that down to earth. I am so curious. When you went to law school, did you have any inkling, any idea that you would end up not only in insurance, but downright passionate about an area of insurance?
No, no, I had no idea. I was unemployed after law school, so I got my master's in tax and went to go work for KPMG. So the economy was rough when I graduated. It was subsequent to the 2008 financial crash. So in 2010, I was with a brand new degree and nothing to do with it. So I marched in to become a state and local tax accountant because the big four are always hiring. And I first saw a captive in terms of how it hit the balance sheet for a company. And from there, I went and read a book on captive insurance, and I really did not understand it. It was a very difficult concept for me to get my hands around because I didn't understand really like what was up with the 831B election and how like you could have like no tax, but there was tax, and like it was this crazy thing. And then I don't know when it was. Eventually, like I guess I read the book just a whole bunch of times, and it started to come together for me. Then I went into insurance defense. I was finally able to use my law degree, and between those two experiences, a captive manager in Atlanta wanted to see if I'd come in house as general counsel, and from there I was able to really just focus on captives. And I found it was difficult to learn. I mean, I had two underwriters above me who owned the company. They did their damnedest to make sure I learned everything they knew. But I just had so many more questions that than they had time for, to be perfectly frank, because they had a company to run. So I got frustrated with the materials out there. So I wrote a book that I would like to see. So I didn't know all these things. So I started just basically, I downloaded every conceivable law review article I could on captive insurance and a whole bunch of things related to reinsurance and workers' compensation. I approached it from my roots. I went after it like a lawyer. So I wrote a treatise on captives called Modern Captive Insurance. And it was pretty well received. I mean, it still gets read every once in a while. Like the American Bar Association published it. I was very proud of that. And that book was immediately out of date. Like the day it hit the market.
I've got to pause you there.
What I know now, go ahead.
I got to pause you there for a second. So right now, the paperback on Amazon is selling for $137.62. Or you can buy it used for $119.
Yeah.
So
worth every penny.
So, but it's meant for attorneys, right? Not for regular humans.
Actually, it was made for the practitioner in mind.
Okay.
So it's made for people like you and me,
okay,
anyone who's interested in insurance, to be able to pick it up and figure out what the heck are these things. Because I just didn't find any non-sleazy materials. So many of them. I mean, there are a handful of good books, and I have them all. They're old though. So there were some material developments, in particular with these tax captives, that really changed the nature of their governance that nobody had published. And I was the first to the market to be able to address all of that. They called the Avrahami case, reserve mechanical, syzygy. My book's the first one to get into risk pooling. I touch on RRGs, risk retention groups. And that was a lot of fun. I mean, it's always nice to be first. And I don't think anyone's really improved upon it, although I'm the first in line to tell you it is absolutely outdated. There are so many things I've learned since I published that thing.
So are you waiting? Are you working on part 2?
I'm very proud of writing a book. I don't know if I'm going to write another one. There are other ways. This medium is better than a book. Websites are better than books. Twitter is a great place. It's just like the books are like, will forever be able to tell everyone I had a well-received treatise, and God damn it, I don't think I'm doing that twice.
Quick parenthesis here. I'm kind of in the same place. So I most of the audience knows I wrote the book on how to engage millennials within insurance. Now this is not $137 300 page legal treatise. This is a 200-page plus references, very easy read business book. And I wrote it in 90 days. Now it took me 5 years to get everything together. But then once my girlfriend came home one day and said, write the book, we wrote it in 90 days, myself and my co-author. And it was very well received, and it changed my career. My life got twisted upside down, and like life has been amazing since. And I very quickly thereafter announced that I was writing 2 more books, that I was writing a book about how to grow your insurance career, and a book about Gen Z in insurance, so the next generation, right? It's now been 5 years. Neither of those books have actually been written. I have the outline for one, the other one, we're halfway working on it. But yeah, like basically, your first book brings a lot of advantages. Your second book really doesn't add much to those advantages.
Yeah, it doesn't move the needle as much.
It doesn't
And
move
so
it, so
my
it's harder to do it.
look at there, my co-author's Light Townsend. He and I talk about this probably about every second or third month. We currently don't have enough bandwidth to do some of our ideas, but there are other ways, and there's websites you can make. I really think that the best way is if you have any amount of credibility in your industry, a well-crafted website with avenues to profitability is a much better way. So it's a freemium style kind of website. I don't want to necessarily outline our idea, but
No.
there's definitely a version 2.0 coming,
Okay.
and it will be digital, and it will probably launch, if I had to guess, in like 2024. There's
Awesome.
just absolutely no chance to me doing it this year.
So we're kind of running out of time. I don't want to keep you late for dinner kind of thing, and I do have a dinner coming up. But this has been a fantastic conversation.
And let me leave you with this.
Yes, absolutely.
If your audience consists of a lot of brokers, then you need to be thinking about agency captives. So where you can really win is if you have a very low loss ratio, if your insurance almost feels like a scam, then get in on the game. Get in on the game, and then reinsure whoever it is that you're writing. So this is a very common strategy. What an agency captive is the agency itself starts a captive, and then you've got the minimum collateral requirements that you then create. And let's assume, for the sake of argument, you are you are selling a lot of commercial trucking auto policies, okay? And you just happen to have the world's greatest drivers, no accidents, and you're looking at 10, 20, $30 million of premium on all these carriers. You sit there and say, look, I'm gonna take that first working layer risk. You're selling 1 mil, 3 mil policies. I'll take 100 grand off of that. I'll take 200 grand off of that. We're gonna price it at this, and I'm gonna take all that commission in for me, and then the rest of it goes up to them. So their commission goes down, or their premium goes down, right? But you're making commission on 100% of the dollars. So your agency is still getting 100% of the commission, and then the premium gets bifurcated however much to satisfy that working layer risk, and then the excess of loss goes up to them. So if the premium for a $1 million policy is, round numbers, $100,000, and then 20% of that goes to the working layer, then you get 20 grand, 80 grand up to the carrier. So they were at 100, now they're down to 80, but your commission remains the same. So if your commission was 10%, you're still making that entire commission. But if there's no claims, reverse engineer. So on $100,000, what's 10% commission? $10,000. But you also had that 20,000 of underwriting premium went into your captive. What happens if there's no claims? You just made $20,000 minus the administrative costs of running your captive. So let's just round ball it all. You could walk out, instead of with 10, you could walk out with $25,000. That's how you get in on the game, and that's how you keep those commercial carrier relationships strong.
So if you've never done a captive, if you're a broker, you've never done a captive, how the heck do you get started? Do you buy the book? Do you give you a call? Like how do you build one of these things?
Yeah, so I would recommend reaching out to me on Twitter, Matthew Queen 84, and just talk to me. So to do a captive, the only problem I have with captives, and I've tried every way I can to get around this, it's just very difficult. They are not good for most personal lines until you get to the ultra high net worth.
Makes sense.
And they really only work with middle markets and big companies. The risk distribution problem is legitimate.
Yeah.
However, if you're working at it doesn't even have to be a big brokerage, but let's say you have a good amount of premium, 2, 5, maybe even 10 million bucks, but you could probably go as low as 2. And you just don't see any, or don't see many losses, or the losses you do see, you're sitting there thinking like, dang, dude, had you just done a little bit of risk management, or maybe if that defense attorney hadn't rolled over, we could really rock and roll in this thing. You gotta look at it. So then step one becomes look at the loss runs for the expected insured group. So if you have a handful of good clients, steady clients, then I would immediately say, okay, let's look at their loss runs for 5 years. And if you don't have 5 years, that's fine. We can use data science to reverse engineer what 2 years looks like. But the more the merrier. Then what you do is you just, it's not complicated. Are the premiums bigger than the claims? If the answer is yes, we need to figure out if there's enough a delta there to be able to find some profit for the agency. Then we can get into the technicalities of how you actually collateralize these things, and if you need reinsurance, you may or may not. How do you find financing for these things? You can use equity or debt, and that's where we can get much more technical. But broadly speaking, I think this is where the industry needs to go, because you're going to lose markets. So I'm asking this happen all the time in skilled nursing. When times get tough, as they are, the options get fewer. If you want to keep a carrier in your market, then it's really nice to be able to say, look, buddy, I'm taking that first $250,000 of loss. So why don't you just stick in the game with me so I don't have to go find like another business partner to stay with. The underwriters are going to eat that up. They're the ones who are going to go off to the executive vice presidents and say, I don't care what Lloyd's in London said. We need to stay here. We don't have a real risk going on in Texas because these guys are doing half our job for us.
Amazing. Like truly, truly amazing.
Thank you.
Yeah. No, and by the way, you're the easiest person to interview ever, because I had to ask you like 2 questions. And you gave a master class on this stuff. Thank you so much. This is truly, I learned more about captives today than ever before. Any recommendations on, like, the only designation that I've heard about for captives is the ACI. I don't know if you've looked at it, but any advice for insurance professionals, whether they're brokers or carriers, who want to get more involved in the captive world? Maybe they don't currently have a program that's big enough to start their own captive, but they want to learn more. Read the book, of course, but any experience with kind of the formal education around captives?
Yeah, I started with Google searches on captives, and there's a bunch of free material out there. ERMI has a lot of good material. The ACI designation, that's not a bad idea. I know plenty of brilliant people in captive insurance have the ACI designation and teach there as well. So I think it is respectable. The only reason I don't have it, haven't had time. So I've recently said, I'm in insure tech lands. I have to do these crazy licenses. I just had to go get my surplus lines license. I'm stuck there. So these more, let's just say, educational licenses, I just haven't had an opportunity. However, there's beyond my book, I think there's a handful of other books I'd be happy to introduce people to.
Oh, yes.
And go ahead.
Go ahead, and if you have them off the top of your head, go ahead and say them. I'll include them in the show notes.
Yeah, so Hale Stewart wrote a pretty good book that
he's been on the podcast.
Yeah, he's got a really good one. It's a little more. So I built on the success of his book.
Okay.
Like I tell him this all the time. So I used his outline in his book to structure the book that we wrote, and then we effectively just added to it. So I really do view it as he passed the torch forward to me in terms of trying to spread the good news. There's probably Catherine Westover. I want to say it was published through ERMI. She wrote a 2-part series, which is actually cheaper than mine. And I used it as source material when I was trying to learn quite a bit about my book. I used her as a reference point. So that's another good one I would look at. David Slen has at least one book on captives. His was a different approach. So he basically just wrote a little bit and then farmed out all the chapters to other people, which I got to look back on. It's freaking genius. I should have done that. All that work.
And Well, it makes you into more of a project manager than an author, but it probably results into a broad view at the topic, right? So I think that'd be super helpful.
Yeah. So yeah, that's all the materials, and of course, I'm available on Twitter. I'm on Twitter probably more than I should be. So that's the easiest place. If you just want to slide in my DMs, I'll talk to you all day about that.
I've got to say, if you get this excited about captives on a podcast or on a plane, people, if you want to learn about captives, next time you're in Atlanta, buy Matthew a beer and let me be a fly on the wall, and you will learn everything you ever wanted to know about captives, and we're too afraid to ask.
Wonderful.
Again, thank you so much for your time. This has been absolutely fascinating. Look forward to stay in touch, and to see you continue to grow all the stuff that you're doing around captives. This is really cool stuff. People say insurance is boring. This is a fascinating world we live in.
I agree. All right, man.
Thank
Have a
you.
good weekend.
Have a good weekend.